So welcome back to episode 21. Today we're joined with Brian Sweeney, and I'll let him give his own introduction.
Yeah, I'm happy to be here. Thanks, guys.
Thanks for being here, Brian.
You know, my background is everything financial, whether it's lending, retirement, mortgage, anything financial related. That's entrepreneurship, business ownership. That's me. That's
awesome.
who I am. That's what I do.
Awesome. Yeah, you have a really unique background, kind of like a jack of all trades in terms of finance, right?
Yeah, I don't know. I think isn't the saying like jack of all trades, master of none?
I don't like that saying.
I don't like it either.
Jack of all trades, master of none, but better than the master of one.
Oh, I didn't know there was more
I didn't
to
hear
that.
I think
that.
there was like a second part of that.
There you go.
See, I
That's
like to
what I
think that I'm just great at everything. So
Yeah,
I don't like that saying.
I'm easily impressed by the best.
Perfect. I like that too. All
That
right.
was Winston Churchill who said that.
Oh, so all right. I like that quote. I'm going to put it in my memory bank. So anyway, yeah, so you guys know each other. This is the first time I'm meeting Brian, and from what I hear, you're obviously like super involved in terms of like real estate investment, maximizing what can come of, let's say, an investment loan. You said commercial investment, things like that. So I want to hear everything.
Where do we start?
So how'd you get started for one?
So my partner and I got started on one property, just like I think most people do, and I think it was back in 2015.
Okay.
It was outside of Pittsburgh. It was, you know, I think I was out of town, and I called my partner. I said, "Hey, Dylan," I said, "Man, got this deal. I want you to go take a look at." I think they wanted $12,000 for it, something ridiculous. He's like, let's split it. We'll go in. We'll fix it up, you know. And so we bought it. I think we painted it. Did the carpets and stuff, maybe put $5 or $6 grand into it, and then had the bank come out and reappraise it and whatnot, and appraised for I think $125,000.
Oh my gosh!
So we were into the deal for 15 or 16
Yeah.
grand,
Wow,
and
that's great.
appraised for 125, and then just kind of snowballed from there. Literally snowballed from there, and just did
So-
the cash out refi.
You
and
did
just
the cash
started
out, okay.
rolling it into other properties. Yeah.
So what was it that kind of like got you started? You know, like what intrigued you in real estate?
Actually, in college, I had an apartment that I lived in, and I went to the landlord. I said, "Hey, I want to buy this apartment," and he goes, "Okay, I can sell it to you. I can sell or finance it to you." And at the time, I'm like, "All right, well, the rents, with the help of my parents at the time, to sign the note, they said, hey, the rents that are coming in from my roommates," I was like, I knew that these rents would cover what the mortgage was,
Right.
So I got started back then in 2009, I think it was, which was an absolute horrible time because I loved real estate. And I was like, oh, this is going to be the greatest thing in the world, but ended up losing money on that deal, but learned a lot because I learned how to get tenants in there after I'd moved out. I was managing it from Pittsburgh, and I went to OU in Athens, Ohio. And so I was managing it from here, and I learned a lot about being able to manage property and the financing behind it and how the lending works, and it just taught me a lot, even though I lost.
Okay. Wow.
So
can't imagine getting started back then.
Yeah, it was a couple $1,000, and I was,
You're still a college student.
Even after
even
I
after.
got out of college and sold it, I think it was 2011. The market hadn't recovered yet,
right.
But I didn't want to keep managing it from afar. Ended up selling it for a couple $1,000 that we bought it for, but I mean, it was well worth it only because I just learned for the last 5 years of that time, all about how to manage property and the rental real estate market. So.
Okay, so would you say that you're more of like a burst strategy kind of guy, like buy and hold, flipper, or do you do kind of?
I mean, we do flips only to pay for the long term stuff.
Okay.
That's really where the flips come in. I think our biggest thing is value add. We want to buy something that we're able to add value to, whether it's paint or windows or a roof. If we walk into a property and we see that it's all completely turnkey, we're kind of like, this may not be the spot for us, Nothing wrong with anything that is turnkey. I think there's a market for it, especially in short-term rentals like Airbnbs and such. But for what we do on that real estate investment side, like rebuilding, renovating,
forcing appreciation.
Yeah, exactly.
Yeah. So you also, and like we were talking about before this, you're a mortgage broker.
Mm-hmm.
Scoot Mortgage.
Scoot Mortgage, yep.
Okay. So maybe tell us a little bit about that.
Yeah, Scoop Mortgage kind of came out of just the experience of working with a lot of clients when we had the accounting firm and sold that about a year ago, and just working with a ton of real estate investors and realizing that they all need financing. And it was just a natural progression into the brokerage side of things, and being able to do lending and warehouse lending and just all the complexities that are involved with lending. I mean, you know, you have retail banks, which are like, you know, the PNCs and the Huntingtons, and then you have the credit unions, and you have the broker side, which I think people just aren't familiar with how brokers work. They think they have to pay us up front, which is just not the case. It's not how it works. Yeah. But they truly do offer a wide array of services and products and solutions that the retail and credit unions don't offer. And so I think for real estate investors, especially whether it's commercial or residential, there's just a huge opportunity in that space.
That's who I always recommend when my buyers come to me and they're like, who should I get a loan from? I always say a broker. Yeah. Go to a broker, because you guys have more, you can kind of create a product almost.
Yeah, I mean, it's kind of wild. It's almost not like the wild, wild west was back in 2008, 2009, or even prior to that, where people were just walking into, you know, mortgage brokers and signing their name on a line and then getting a loan for $500,000. But I think it's changed to the point where they are able to structure deals and customize the loans, and we have the ability to go out and shop 50 different wholesale lenders. Whereas, you know, a PNC or a retail lender, that's all they have.
Bound by them, yeah.
You know, and, you know, there's also tons of hidden fees with these retail shops that no one talks about.
Yeah.
So on the broker side, we're not allowed to charge those. And so you really have full transparency. And I think, you know, most people are saving like on average $5 or $6 grand with working with a broker, which, you know, that's $5 or $6 grand out of the borrower's pocket. So.
Yeah. Why would you want to pay that? Yeah, what kind of investment loans do you specialize in?
So we do everything DSCR, commercial.
So can you explain what that is for people that don't know?
Yeah, so a DSCR loan stands for debt service coverage ratio, and that basically means they're just taking their rental income on that property if it's already leased out. If it's not, then you probably wouldn't want to go DSCR, but you're taking the rental income from that property and you're using it to qualify the loan in the sense of how much income is coming in, how much is the mortgage going to be, and does that income cover the debt? And what is the ratio between the debt and the mortgage, right? And the rental income?
That's super advantageous if you want to do like an Airbnb.
Yes.
Well, you wouldn't really know what the income would be.
You would have to project out.
Yeah.
But if you have past like if you're refinancing, it's a no-brainer because you actually have physical documents that say.
So you can't. So you're doing that's more for long-term leases than short-term.
It's going to be a lot easier on a long-term lease than it is going to be on a short-term rental property. Yeah.
Okay. Then what are the other ones? I'm shopping for myself too because I'm looking to invest in a rental. I have 3 single-family rentals, but I want to get into the Airbnb game and I want to get into the multifamily game. So I'm shopping for me right now.
All right, so let's talk about that for a second. So I have a couple Airbnbs.
She might be your next customer, by the way.
So Airbnb. Honestly, home equity lines of credit are great for Airbnbs because if you have a ton of equity built into the property already, that maybe you're not purchasing it if you already own it, a home equity line of credit, going back to like a credit union, they're going to be the best for that because they can offer the rates at super low.
Okay.
But then you could access the funds if you need it. If you don't want it, why pay on it if you don't have to?
Right.
But, you know, as far as investment property loans go, you have what's called non-QM. Are you guys familiar with that?
Yeah.
Like non-qual. I mean, bank statement loans.
Which is advantageous for me because I don't do W-2. Yeah. And I write off everything.
Yeah. Yeah.
Okay.
Yeah. You're going to be a tough cookie.
Yeah.
No, but you're self-employed.
Yeah.
And so, you know, you probably would go non-QM. And there's nothing wrong with non-QM. It actually just makes it an easier process for a lot of people that don't have W-2 income. I mean, that's all it really comes down to. It's just not an investor driven on the back end by Fannie Mae or Freddie Mac, who are the investors that buy the servicing rights and buy the mortgages from the lenders. So, you know, if people don't understand how that works, is if you get a mortgage, right, and you do the loan with, let's just use PNC for example. And PNC will then sell that mortgage off on the secondary market to Freddie or Fannie, whomever those guidelines they were with in the first place. So they have to meet those investor guidelines. That's why when you get a mortgage, they're asking for all this documentation.
Yeah.
Right. They're saying, send me your pay stubs, send me your bank statements, send me all these things. They're not doing it because they want to, piss you off with all the documents they need. They're doing it because they have to meet the investor guidelines on the back end, who's going to be buying that particular loan.
Got it. Okay.
Yeah. So for the first time investor, right, because we get I'd say we probably have a mixed demographic that we draw from. So for the first time investor, what would you recommend in terms of investment products for them? Let's just say they rent right now, they're single. Yeah, they're not married.
House hacking is a no-brainer.
Which would you say FHA?
Yeah, so house hacking is basically buying a duplex or a triplex or fourplex and living in one unit, qualifying for an FHA or conventional loan with 3% or 5% down, and using that as your primary residence for better rates and better terms, and then eventually moving out, re-renting that spot, and then going and kind of moving on from that particular product. So that's a no-brainer.
Would you try to get qualified for FHA if you're them? If the property's suitable for it?
People will always worry about PMI. And if you buy something like we mentioned before that maybe has a little bit of value add or forced appreciation, then you don't have to worry as much about the PMI because you can always refi out of that.
Mm-hmm.
But, if you qualify for conventional, you have good credit. If you have decent credit, credit's a big thing. Take care of your credit. I mean, if you don't have good credit, then go get a credit repair company to help you. It costs you a couple $100, and it will save you thousands of dollars on your mortgage.
Right. Yeah, and also the reason, with the FHA, it's because a lot of people don't have the money, the 20% to put down, 25%, depending on what it is. So they're looking at it from that lens too. So that's kind of where, obviously, the property has to qualify for it, in terms of the structure and the inspection that's going to have to happen.
That's the tough part is FHA. If you're buying a triplex or a duplex or whatever it may be, a lot of times if you're buying it right, it may need some repairs.
And that's going to throw you out. Yeah, right.
So it's kind of like a catch-22.
Yeah.
But I always say if you have good enough credit, always try and go conventional. Because if you're a first-time home buyer, conventional, you could put 3% down.
Right. Okay. Yeah.
People can always confuse that, and they say, FHA is 3.5%, but forget that conventional is 3% on a first-time home purchase.
What's the rate's still going to be higher though on that?
It's going to be higher than FHA. But
I don't get tied up in the rate, but I understand that some people will sit there right now, for example, rates are. I just told you before this. I just got quoted at 7675 on a commercial refi, and it was at 4.25. I bought it June 2020. There's so much equity in it, so it's it's a no-brainer for me because I know that I'm not going to take that out and go buy a boat. I'm taking it out because I'm going to end up at a net positive. I got
a better contact for you for that one. You're not going to be at 7.6.
All right, is it you?
No, it's not me. It's not me. It's a local guy here in town.
I got to meet him too.
Yeah, I guess my thought process as it relates to rates is that, we talk about this all the time. You have to buy access.
Exactly.
And you could always refinance down, years down the line. I'm not saying you're going to get it at 2%, 3% again, but you're still going to be able to get it. And at the end of the day, if it's going to yield you a couple $100 less on that, if a couple $100 is going to make or break the deal, it's not the right deal.
No. Or you're not ready for it.
Or you're not ready for it, right.
You got to have that mindset, buy access, because that calms me down too. And I preach that all the time to my buyers because they're nervous. What's going to happen? Is this economy going to bottom out? And I don't have the answer. I'm in the same ocean as you riding the wave. I'm trying to figure out my next investment step. But if you have someone,
rates jumped up 50 basis points on Friday last week.
Right.
So you're talking one day the Treasury yield goes from 2.85 to 3.3 in the matter of 25 minutes. Today the Fed's talking, so at 2:30 or 3 o'clock today, we're going to find out if they raise and bump the Fed funds up by another 75 basis points. So
so in 30 minutes.
Yeah,
this becomes a
5
watch
minutes
party.
It comes out.
Hurry up and lock your rate.
You're dealing with a whole bunch of different things right now, not just real estate. This is much larger than just buying and selling real estate right now. I think there's a lot of other factors that are taking place here.
It's a shit show. I'll just say what it is. Everything right now is just a disaster. But I'm optimistic as it relates to real estate. I'm always optimistic as it relates to real estate.
Especially in our 30s, this is our money making years. I'm not going to sit here and not make a decision to play it safe. I'm going to make the decision, and if I still have the luxury of saving myself if I make a decision that doesn't.
Right, you have time on your side.
My buddy always says it's learn in your 20s, build in your 30s, and cruise in your 40s.
That's what I want to do.
There you go. I like it.
That's what I...
So what do you think? Obviously, you said there's a bunch of stuff going on right now. Let's just, if we're sticking to real estate, what would you say? What would you say to somebody that doesn't? What would you say to like Anna right now that's looking for a multi-unit? You know, I don't think she's not deterred by rates, right? But for somebody maybe that might be, like, how do you feel?
I'm a gambler.
Right. What would you say? How do you feel about that overall real estate market? Where do you see it going?
I think it's tough right now. I mean, you have to buy it right for sure. Mm-hmm. I like the short-term rental market right now. I think that's a good space to be in. I think, single family, I probably would stay away from.
I agree.
Just because you have companies like Blackstone or BlackRock and Invitation Home. I mean, I think Invitation Homes bought 80,000 single-family homes last year. I mean, how are you going to compete with that?
Right.
They're cash.
They're buying up blocks. City blocks.
That's what worries me.
So
as an agent, those houses will never be for sale again.
Though they might be, but they might be significantly lower, and then the comps get hurt. So it's just this big whirlwind effect.
That could be a
because if they want to liquidate a portion of that,
they want to liquidate a portion. They don't care about losing because they already wrote off all the depreciation anyways. Mm-hmm. So
saturate the market.
Yeah, then they drop everything by 20% or so. And then it hurts the comps for every other buyer that's buying single family or selling single family. Yeah. So it really creates this tidal wave effect that I think single family could get hurt. Especially. Do
you think there should be regulation for that?
You believe in capitalism?
Yes, absolutely.
I like the response.
I mean, I don't know. No.
Answer with an answer.
I mean, if I go out, if we all sat here and had $50 million in our pockets
I'm doing the
and
same
said,
thing.
hey, let's create a real estate fund, and then we went out and bought every single family home within the 5-mile radius.
If I could, I would.
Right.
What? And then someone stepped in and said, hey, you can't do that anymore. You'd be like, what?
I know. I work with a fund, and they have 10 million. They're little on the grand scale of things, but that's what they do. Their goal is 100 million.
Yeah.
And they're absorbing in 16 markets, and they have a strategy. They have a yield percentage I have to find for them to make the offer, and it's good short term for me. But long term, how does that affect the future?
You're talking about a company like Invitation Homes that's working with billions of dollars, and they're buying property sight unseen, just writing checks for them.
It's pretty wild, that sector of the market.
Yeah. So I think that's tough to compete with, like asking about, where would you go with it right now? That's really hard. I probably wouldn't want to go up against them. And they're the ones making offers on properties that are $15,000, $20,000, $30,000, $50,000 above asking.
Well, Zillow tried to do that, didn't they?
They did. They lost.
Burned.
They lost like $500 million doing that.
Good.
I
can't stand Zillow.
So
now they started a mortgage company, Zillow Mortgages. I've been seeing commercials on.
Oh, they did.
Are they?
I didn't see
so
that.
are they rivaling? Are they rivals of Quicken Loans? So
Quicken's now known as like Rocket Mortgage,
right?
Which
the
is
microwave
they're just complete
loans.
trash.
Yeah, that's what I call
them. Yeah, I mean, if anyone has a Rocket Mortgage loan that they're looking at getting, like they're being overcharged by.
My loans always get sold off to them somehow. Like my Florida property did.
Rights,
yeah, the servicing did. Yeah.
Oh wow.
Yeah, they get bounced all over the place. So then, are you bullish on real estate then? Obviously, over the long term, how do you feel short term? Obviously, the right property. If you could force the appreciation,
I think long term, it's a no brainer. I mean, it's
yeah, right.
Up. Short term, it's going down. I think.
Yeah.
I'd be hesitant. We haven't bought anything in the last 14 months. I think it's been.
Okay.
12. It's been 14 months. I think we closed on our last deal on May 18th of last year. So it's been 13 months.
Okay. Just because you wanted to ride it out, you felt like pricing was too high.
I felt. Actually, no. We did buy something in July of last year. So I take that back. I just felt like in December or January, when you had the stock market started to tank, and then rates started to tick up, and then inflation numbers started coming out. That is usually a good recipe for rental income because rents go up with inflation, but it's a disaster for real estate appreciation prices.
Sure.
And so I think we just went too fast, too quick, too far, too fast. And there has to be some sort of like, there's always mean reversion. Like the big bell curve.
Yeah.
You always have mean reversion no matter what it is, right? Whether it's like lifting or, whether it's driving your driving the speed limit. If you drive 80 miles an hour, you can only do it for so long. You're going to end up slowing down and going back to the speed limit. So, you know, same with real estate, same with the stock market. Everything always ends kind of reverting to the mean, and you have that averages. I just saw a thing today that was saying, like, you know, real estate has been up almost 50% over the last 3 years. Okay. But
absurd.
If you take into consideration 08 and 09, the last 20 years, we still have an average appreciation of like 8%. So it's always still reverting back to that mean because we had significant drops just almost, you know, 10 or 12 years ago.
Right.
So, you know, I think if you buy right now, you have to buy it right.
Right. Yeah, no, that's the key, you know. So like I feel like
we see all these properties. It's like knowing what's right.
Yeah, well, yeah. I mean, that's the tough part, is because for me, if you said you have a lot of followers that are maybe first-time investors. The easiest thing you can do as a first-time investor is just go buy something.
Yeah, you have to learn. Like you said, you lost on your first deal.
Yeah, I mean,
but you gained an education.
Yeah, I mean, and that's going to be way cheaper than anything else.
Yeah.
So
I lost on my first flip.
You have to go out and just buy something.
Yeah.
You know, don't overexert yourself or over-leverage yourself, or if you lose, you have to file bankruptcy. But go buy something and learn, and then make a decision from there. I mean, it's tough right now just competing with all, you know, these on the single family. I mean, most people want single family to start and stuff. Yeah,
I hate single family, but I'm more of a multi, just because of, especially over the last few years, you know, you see what the values are, you know, and you know what you need to get for rent and what you're capable of actually renting it at. But multi-units, like, I did buy the one, you know, I bought a 4-unit in Rochester. I definitely paid more than I didn't commit the ask, didn't go over. I still got it for below the list, but the numbers still made sense. They made hell of a lot of sense.
Well, in this area, the numbers
make sense.
No,
it's not going to appreciate.
Yeah,
that's the deal. You know, I'm making 40% on my cash, so it's like it's a no-brainer in that regard. So it's a pay down. You know, it's a principal pay down long term for me.
I think single-family homes right now, the competition. So I think 20 years ago, think about it like this: 20 years ago, you had an agent, right, that would send you deals. You didn't have Zillow. You know, YouTube didn't even come out until I think 05 or 06.
Which is crazy.
Which is great, right? So you had Zillow and all these companies, and Trulia and, you know, and LoopNet. They didn't even come out until like 2010. So 10 or 15 years ago, 20 years ago, you had agents that would send you deals. And usually if they send you a really good deal, you would jump on it because you had the competitive advantage of buying that property. Right. But now I'm competing against you. I'm competing against her. I'm competing against everybody on TikTok and Instagram that knows anything about real estate. For a single family property, I'm competing against everyone. For the same deal. You have Invitation Homes that's competing against you as a guy that maybe has $10,000 is going to buy their first deal. You have a first timer, and then you have Invitation Homes that has $8 billion in property. You're competing for the same house.
Right.
It's absolutely crazy.
It almost evolves or devolves back to the way it was prior to the internet and having those days where you have to have an agent or somebody who's in the know.
No question.
Before it comes on the market. It's competitive.
That's where I was going with that. It's like if you can get something off market through a pocket listing, that's a no-brainer. But trying to compete on the MLS right now through Zillow and looking at properties, it's just I wouldn't do it because you're the competition. There's no competitive advantage. You're not taking a single-family residence, a 3-bed, 2-bathroom house in Pittsburgh area, let's say, and coming up with some grand idea of how you're going to make so much money on it. I mean, it's pretty straightforward. Like, it's going to rent for X. You're going to buy it for Y. That's the bottom line. Right? I mean, you're going to have maybe some cash flow, maybe some appreciation. But on commercial properties, it's totally different because you can come up with ideas, whether it's a 5-unit or a 10-unit. You can transform the units, make them nicer, make the parking lot nicer, add a pool. Well, you could do so many different things on the commercial side that you just can't do to a single-family residence. And the cap rates make those properties much more valuable over time. And same with like actual commercial real estate. If you get a really good tenant, then that value of that property significantly increases just like that. So I think, single family rentals right now are just really hard to want to really be excited about.
I don't have anybody that comes to me and says, I want single family rentals only. I don't have that.
Yeah, that makes sense from a flip perspective. I mean, I'm not touching a flip right now.
Yeah,
but
I'm in like 3 of them right now.
Yeah, it depends on the
gambler.
market that you're in there too. What's that?
I said I'm a gambler.
He's a gambler.
Yeah,
but I bought all of them off market. But I have that edge because I'm in the business, so it's kind of
They were your own listings, I'm sure.
Right.
No, they were just people I knew.
Right.
I don't even list them, so obviously, but
So
that's been the advantage that I've had.
So let's try to like transition to more of like a more of an experienced investor, right? So as it relates to like leverage, you know, how do you view leverage? You know, you have a portfolio of properties. I know we were talking a little bit about that, about portfolio loans, lines of credit, that sort of stuff. You know, maybe touch base on that a little bit.
Yeah. So, I mean, we have 40-something properties, and you know, I think that's not a great. It's a lot, but it's not a ton. And I think leverage plays a role in how we got to that point. Real estate's one of the only businesses that if you don't have cash at all times, then you'll go broke. Because the thing with real estate is it doesn't matter how much cash you have, you always need more. I don't care how much money you have. Look at Invitation Homes, for example. So I think that part is leverage in general plays a huge role. But that being said, I think Warren Buffett said that leverage is the only thing that can make a smart person go broke. Because if you don't use it wisely, you know, then it can cost you big time. So we always try to keep at least 80% loan to value on, even if we have a lines of credit out, et cetera, which we do. We do have a portfolio blanket loan on some of our properties that we then have a line of credit against that we can then use to buy properties cash. And then our relationship will then re-am that portion that we bought out on that line of credit and pay it back, and we'll be able to reuse it again. So,
so how's that look? I don't know if we actually dug into this earlier. So you have a portfolio of properties, right?
Let's just say that 10 of the properties are collateralized.
Okay.
And let's say that those properties are worth $2 million.
So like step one would be, you know, you would have to identify a lender, right, that would be able to do this, or a broker in this case.
Yeah.
And then do you have to get all of those properties appraised?
Yes.
Okay, so you're going to get all of those appraised. So you have some upfront costs tied to it.
Yeah, you're going
right?
to, I think
probably get a
deal
on it. Yeah, because
you're $400 per location.
Okay.
Like
and these are all single family?
No, I think let's just use 10 properties. I think one was a 5-unit, one was a 4-unit, and then there was like a couple single families.
Okay, gotcha.
Let's just say that portfolio is worth of properties is $2 million.
Okay.
So that $2 million, then we go to the bank and say, hey, let's just say that we have 0 loans on those.
Okay.
So we go to the bank and say, hey, we have no no mortgage on this property, on these properties. We want a line of credit against it. We're going to do a blanket loan. And they say, okay, what we're going to do is we're going to collateralize all of them. We're going to give you a secured line against this for 25% or 50% of the value of these properties. So we're going to give you a line of credit for $1 million against these properties. That $1 million sits in, you know, some sort of sub account of our checking account, our business account, and then we can move money back and forth as we deem fit. But we can then use that cash to make improvements, to offer on properties, cash offers on properties, and then how it works from there is, let's just say that you buy a property for $100,000. Once we close on that property, the $100,000 obviously comes off the line of credit. So now the line of credit is at $900,000. Once we close, the bank will then, or the broker, whomever, will then refi that $100,000 at 80% or 90%, and hopefully that property that we bought for $100 is worth more than $100. Hopefully it's worth $125.
Like you're buying it cash. Hopefully you get a deal on it.
Get a deal. Yeah. Maybe we improve it a little bit before we refi.
Will you use that line of credit to improve as well?
Use it to improve. Okay. Let's say that we bought it for $100 and we're going to put $50,000 remodel in it, and now it appraises for $300.
Right.
Okay. Well, then they give us 80% back loan to value, so we're able to take the funds that we got in the refinance. Now it's a long term. It's termed out over 25 years. We pay the line of credit back. It's now back up to $1 million, and we have a loan on the property.
So they're doing a cash out on it, then, is what you're saying.
That's right. Yep.
So you're going to do a cash out on it. You have enough to be able to do that, and you're holding an asset, cash flow. Okay. So say you do have a loan on all those properties. So your property's worth $2 million, but let's just say you have $1 million in equity. You're just only able to borrow a percentage of that equity.
Yeah, you would. Yeah.
So it's 80%, $800,000. Right.
Yeah. Well, you'd be able to. let's say 80% of the 2 million.
So it would be based off of the value of the portfolio, or would you deduct your notes
it's based
from
upon the value of the portfolio. So if it's 2 million, and 80% of that would be 1.6 million. If you have $1 million loan, they'd give you a line for $600K.
I got you. Okay, yeah, that makes so it's going to be off the portfolio value, and then you're gonna at that. I see what you're saying.
Yep.
That makes. And
then as you get more properties, hopefully they're appreciating in value. Then the line can go up as well.
Okay.
Right.
What are they? So like on that portfolio, well, so you're putting them under a portfolio, right? So like the first step would obviously be to do that. Then you're going to take out a home equity line of credit against that, or a line of credit against the portfolio.
Yeah, it's not home equity,
right?
But so it's literally a business
line.
Yeah, it's against your real estate business, basically. You group them. I think all of our properties together might be worth like 4.5 million, 4.6 million. So I think however they do that calculation, not all of them are collateralized, but a portion that we did a couple 1031s. And they have a lot of equity built up because the 1031 funds that float over. So we just use those ones as the collateral.
Okay. So what did that look like? Because I came close to doing a 1031, but I worried about, and then I learned, that you could do a reverse 1031, so where you're actually buying a property and if you obviously have closed within the 120 days, the whole thing, you could do it backwards. But so how did that process work? You said you did it twice?
We've done it 2 or 3 or 4 times, yeah.
Okay. So for one, how do you feel about deferring taxes? And two,
phenomenal.
Yeah, okay.
I mean, it's so here's the thing. When you defer the taxes, you never end up seeing in your pocket.
Right.
That's the hard part. Is like, I always have guys tell me, "Oh, I made $500,000 on this deal," and I'm like, "Did you though?"
Right.
Well, I deferred it 1031. I'm like, so. You didn't really, you made it, but you didn't make it.
Yeah,
You
right.
didn't see it. You're not going out to dinner and using the profits from your 1031 to pay for dinner.
Right.
Unless you go do a line of credit against it.
Unless you're doing it, yeah.
So it's kind of all flows, kind of comes full circle. But, I mean, it's not hard. These 1031 companies, I think we used 1031X. They're out of Cincinnati. They just pretty much take care of everything for you. But, if you have a significant amount of gain, and you have a high tax bracket, and you're not a real estate professional, right, and you can't deduct all these expenses because you have a W-2 job or whatever it is, obviously you're able to do that. Mm-hmm. But if you can't, then it probably does make sense to do a 1031 and then borrow against it and get your money back out that way. Mm-hmm. Because debt's not taxed. We all have seen those videos online.
Right.
So if you cash out if you make $400,000 and say that you cash out even 50% loan to value, you're able to get $200,000 back and use that for whatever you want.
Right.
Better to pay no taxes on 200 than taxes on 400.
Yeah, that's my viewpoint. Rather than now, I had a short-term rental in Ocean City for 5 years. Just this ridiculous influx of appreciation everywhere. Right. So I sold it with the mindset that, all right, I'm going to upgrade. Yep. Right. And I knew that I wanted to do that, but I couldn't find anything. The inventory was, down there, it was like 600 to 700 listings on MLS daily, and it was down to 70. It's like there was nothing. So everything was just through the roof. And so I ended up having to do that. I just ended up having to pay the tax on it. Maryland, withheld like 8 or 9% anyways, just for the state. Yep. And I was just kind of, I just had to just bite the bullet and be done with it, but then reinvest it elsewhere. So I'm kind of happy that I did do that, because I could just use that money to put across multiple things, which I could do that at 1031 too. You could put it across multiple properties, but you have to be able to identify multiple properties and get under contract with multiples. Yeah. And if you don't, then you're paying the tax anyways, or at least the tax on the remaining amount.
Yeah,
it's complex, but it's different though. You hear different viewpoints.
It really depends. Like if you're planning on holding your properties in perpetuity, so for as long as you can think, right? As long as your mind goes out until you die. If your kids want them or whatever it may be, your heirs or whatever. Then there is some value there's a lot of value with 1031s because eventually people say, oh, well, you're just kicking the can down the road. But if you kick it all the way to the end,
step up.
You get a step up basis, which means that there was never any taxes paid, which is pretty wild and definitely a massive loophole in the tax code. But I mean, I don't know who's thinking about, that.
Yeah.
At 30-something years old, I'm 90 years old, I'm going to have a step-up basis. And my kids, grandkids are going to get this.
But so, I guess then the question would become, if the ones that you 1031, when did you do that? Like 5 years? Because your income bracket, your tax bracket continues to go up. I mean, like you said, you're in your money-making years, right? So, like, your tax bracket continues to go up, right? So if you defer those taxes, you know, and you end up selling,
that's the thing. That's what
you're paying more.
Yeah, exactly.
You know,
I mean, if it's like your first deal and you don't have a job and you're 1031, it makes no sense to do a 1031.
Right.
Yeah.
Take the depreciation as much as you can and pay the taxes, because if you're planning on being successful, which I've never met anyone in the real estate business that is saying, "Yeah, I don't want to be successful when I'm getting into this,"
right.
You know? If you're getting into the business and you want to be successful and you're going to grow, then your tax bracket is going to go up and you're going to be making more money and generating more cash flow. And if you do sell a property and don't 1031 it, you're going to owe a hell of a lot more taxes than you would know,
right.
or would now. So,
or I mean, if you do get to, you know, 65 or 70 years old, you know, maybe your tax bracket's less if you're working full time throughout those years too. Say you're not trying to acquire, you know, and you don't have that W-2 income that's going against you. So then that's a strategy too. Now you're going to have a hell of a lot. I mean, depending on how many times you did it, you're going to have a hell of a, you might as well at that point just ride it out then.
Or you could not, I mean, you could take the money and then cost seg a property, a new property that you buy, and then write down the depreciation on that property off of, you know, so there's numerous ways you can do it. It really depends on what's right for you.
Right. So, you know, I wanted to pivot a little bit. I know you didn't want to go here with it in terms of taxes and whatnot.
Oh, taxes, great, love them.
But so you have a background.
Yeah.
You're
I
won't say what your title is.
Background in taxes. Yeah. I used to own an accounting firm.
Okay. So first, did you deal with a lot of real estate investors?
Yeah. So actually, our niche was. So how I got into taxes was when I worked at Merrill Lynch downtown. Actually, and I was in the investment banking side of things, wealth management. Still am, but then obviously wealthy clients tend to be in real estate. It's just how.
Well, I was going to say, what percent would you say?
It's high. It's
over 50?
I mean, I would say
all the benefits.
I would say between business owner, you know, my wealthiest between business ownership and real estate, it was damn near 100%.
Really?
Yeah.
Wow.
That's a message.
I mean, I'm talking, you know, I'm talking the people that had significant.
Yeah, the people that are right.
Yeah, and I'm, you know, not the person that has a $50,000 401k rollover, right? I mean,
right.
Not that anything wrong with that, but significant amounts of wealth. They're always involved.
There's a real estate component to it.
Yeah.
So let me ask you this then, because you're exposed to both. You're still, you're not a CFP, are you?
Yeah.
You are. You're a CFP, a sort of a financial planner. So then in that case, how do you view real estate in comparison to the market?
Yeah.
You know, we've talked about this a little bit, you know, but I'm a firm believer personally in maximizing every bucket that you can.
100%.
Yeah.
I am biased towards real estate. I think there's more advantages to it, but I'll let you take it from there.
So I did a podcast on this a couple years ago. I always say be safe, do both. But, you know, the real benefit with the stock market is you can be passive. You can go and you could hire a financial person. You know, I think the financial wealth management world has changed drastically over the last 5 or 6 years. It used to be like, I'm going to manage your money and we're going to be picking individual stocks, but not me, not anyone out there, even if they tell you they can, are picking winners day in and day out.
Right.
This is not happening.
It's not, yeah.
Okay. And if they think they are, if they would look at their track record over the last 10 years, the S&P 500 on a 99% of the time has beat their performance. So it's kind of irrelevant. But I think the wealth management industry has become this complex planning realm now where it's helping with taxes, it's helping with estate planning, it's helping with real estate, it's helping with all these things. And that's where it's shifted. So back to your question, I think in the market, if you don't just invest in the S&P 500, if you're not just a passive investor, which is fine, the competitive advantage lies in being able to value businesses and understanding accounting, because that's the language of business. Mm-hmm. If you understand accounting and can value a stock on your own and you can see it's undervalued and know this company should be worth a hell of a lot more, but it's only trading at $50 a share. It should be trading at $100. That's value.
Right.
That makes a lot of sense, right?
Right.
You can make a lot of money doing that. It takes a lot of time. Real estate is the same thing we just talked about. If you're trying to buy single-family houses, probably not a lot of competitive advantage there. You just can't do it. But if you can go out and find a vacant piece of land or find a commercial property or a 10 unit and say, I have a better mousetrap for this use. I have a better use of this particular corner lot or this piece of land that's not being done right now, you can create tons of value. I mean, think about it. Think about 25 or 30 years ago in real estate, how many, like, the people in Pittsburgh or Columbus or New York City or anywhere really that developed property and had made millions and millions and millions of dollars on that deal.
Yeah.
Right? If they had taken their money and put that in the stock market 30 years ago, they probably would have made a lot of money.
Right.
But it would have been it would have been a lot less hands-on.
For sure.
It would have been passive, but they wouldn't have created value because when you're using leverage and the bank's money, you know, if I go get a loan, 20% loan to value, and it's $1 million loan, the bank's giving me $800,000.
Right.
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 I mean, they're giving me 800, and then if I sell it for $2 million, they don't take back 80% of their profits. They give me all the profit.
Right.
So I only have to put 20% of the money up, but I get 100% of the profits.
And you're still getting that, exactly.
You know, so that, I mean, it's kind of hard to argue with that. But I think if you compare the two, the stock market and real estate, it's almost identical how they perform over the course of 50 years.
Right.
The market does outperform just a little bit, but you're also not you're talking about pure appreciation and not talking about dividends or cash flow from rental properties. So you're not talking about
all those other benefits.
You're talking about all the extra cash flow that's coming in the door that factors in. So,
right.
You know, I mean, it's a great debate, and it'll never end. I think real estate is good for people that like to be a little more hands-on, and you know, but the stock market is obviously phenomenal as well. I mean, be safe, do both.
I like that. I like it. So then, what about people that are leveraging their brokerage accounts to purchase real estate? What do you think about that? That's absolutely stupid. Yeah. I mean, that's so what are those called? They're
IRAs.
They're IRA
margin accounts.
Well,
you're talking about self-directed IRAs.
Yes,
that's different. Okay, I thought you meant. Okay, so let's take a step back. If you're leveraging your brokerage account, and I actually had a client in the accounting when we were dealing with accounting because we used to work with customers all across the country, real estate investors, whether developers, hard money guys. I mean, you name it. We had over 250 clients across the country that were all involved in real estate. And we would have people that would borrow against their margin account or their brokerage account and buy real estate. So there's two different aspects of that. There's a line of credit you can get against your brokerage account. That I'm okay with.
Okay, that's what I was
That makes sense. But there's people that borrow against their margin account.
Oh, my gosh. I didn't realize you could even do that.
You can.
So you could use your margin account to purchase anything.
You can literally transfer money off your margin account, like through Fidelity or TD Ameritrade or E-Trade or whatever.
But how are they evaluating the performance on the market? Because
they're valuing it based on the performance of your portfolio. Let's say you have $100,000.
I thought they're using the margin on okay, go ahead.
Let's say you have $100,000 in a stock account. Let's say you own Apple stock.
Mm-hmm.
Let's say it's worth $100,000. And let's say that you have margin on that account, and your margin buying power might be $150,000 because they give you some sort of X component on that account. Well, you can technically pull out cash and not sell your stock.
Okay.
So let's say you pull out $25,000 and you're going to go buy a property. Well, if that stock drops by 25% or 30%, whatever, you're going to have a margin call.
You're going to get a call. Yep.
And then you're going to have to put money back into the account, not only to cover the margin, but to cover the difference between the two.
Yeah.
And so I think that's just playing with fire.
Oh, yeah. That's like Dave Portnoy. Dave's he's a huge margin. I mean, through the market, I love him.
No, he's trading on margin. I mean,
he's also worth,
He's also doing intraday trading, which is different. Let's say you have $100,000 in an account. Like intraday, they'll give you 4 times your money. So let's say that you're trading Apple stock, they're going to give you $400,000 to trade with intraday only.
So you have to buy and sell within that day.
You have to buy and sell within that day. So you can't roll that.
Jeez, that's so risky, though.
Yeah, I mean, think about it like this. If you're buying U.S. Steel stock, which is a very volatile stock, I just named that because they're headquartered here in Pittsburgh, but they trade, their average volume is tremendously high, and they trade on average like 3 or 4% in either direction every single day. So let's say that you trade $400,000 worth. Well, if you make 4%, that's $16,000 you made in a day. That's pretty good, right? But you can't hold it overnight. And if you try to hold it, they just automatically sell it out.
Jeez.
So if you're down, if you're down $16,000, you're going to wake up the next day with $84,000 in your account instead of $100.
Right. That's wild. So then, in terms of self-directed IRAs, which is different against that,
I think that's cool. I mean, it's a good way to do it. Not the stock market's not. It's not right for everyone. You know, I think it takes, unless you're going to do passive investing, it takes a skilled individual to pick winners.
Right.
True winner. It's almost like the crypto market. I mean, obviously you have like, you know, Bitcoin is like the main. I compare Bitcoin to the S&P 500.
Right.
Bitcoin, you can just buy it and hopefully it goes up over time. But all these other crazy names that are out there, those are just...
Yeah, you have a bunch of SPACs running around.
Yeah, I mean, it's just it's a bunch of nothingness that's just floating out there. It's a bunch of these pennies. It's like penny stocks.
It is, yeah. You know, it's even better, yeah.
You know, it's
volatile.
You're either going to make a lot or you're going to lose everything.
Yeah.
And so I think self-directed IRAs are a safer way to invest in real estate. They're just tax deferment. I think it's a good way to do things.
And all the proceeds have to go back into that IRA. Yeah. So you can't actually touch anything, right?
Unless you're 59 and a half, then you could.
Okay.
If you're 59 and a half.
At that point, you could just liquidate it, though, anyways, right?
But you would have to pay the taxes on it.
Okay.
So the benefit of using it would be to not having to pay the taxes up front. You can actually defer those taxes and choose when you want to pull them out.
It's interesting. Obviously, there's the benefits to that, but you can't touch the cash flow. You know,
no,
so
you can't. Well,
you're just
you can't touch.
You're owning the property, hoping that you're getting the appreciation, but I mean, you can't. It's not actually.
Here's the other crazy part about that is let's say you buy a property for $500,000 and you get a loan for $250,000, and then you use $250,000 from your self-directed IRA. Only 50% of it is counted because the other 50% is from the bank.
Right.
So it's almost like you're in a partnership 50-50 with the bank.
Okay. Gotcha.
Yeah, so
wow.
It's kind of it's weird how they structure those, but if you're buying with your self-directed, you're going to want to buy the property in its entirety. You're not going to want to get a loan on it because it just complicates the accounting aspect of it.
That's awesome. Good stuff. That was awesome.
Yeah, so they mainly use the IRA for like retirement because you can't touch it till you're 59 and a half. So is it true that you get taxed on when you started the IRA, not when you retire?
You get taxed on when you started the IRA. I think what you're asking is...
Like when you finally liquidate and you're ready to enjoy the golden years. You're taking your liquid out.
Yeah, so let's say you put 100 in.
At like 25.
Let's say at 25. And that grows to $1 million. You're going to be taxed on the 900.
Oh, okay.
That's your gain, yeah.
So it really doesn't matter what age you started.
But you're going to be taxed at not capital gains rates. You're going to be taxed at ordinary income rates.
I see. Okay, for some reason I thought, because when I started when I was 25, and I thought, oh, I better start it now so I get taxed when I'm 25, because I plan on being way more successful when I'm retired.
You're talking about two different things. You're talking about Roth IRA versus a traditional IRA.
Oh, is that what I'm thinking? Got it. Okay.
Yeah, so a Roth IRA, that's exactly what that is. You're prepaying the taxes up front.
Right.
So you don't have to pay them down the road.
That's what I did.
A traditional IRA is you take the deduction on your tax return, and you don't pay the taxes.
$6,000 a year.
Yeah.
So it'd be like a 401k gets rolled over into that, right? So you're taking it out of your gross. It's coming out of your gross income, which you're 1099. So you wouldn't have that.
You might have like a SEP IRA.
Yeah.
None of this is financial advice.
I have to Google SEP IRA.
A SEP IRA is a simple employee pension, but basically it's a IRA for self-employed.
Okay.
There's higher limits. Instead of $6,000 a year, you can do I think like $58,000.
It's 50 something. Yeah.
Oh, okay. I'll Google it.
There you go.
Google it.
Yeah.
Get on the old Google machine.
Yeah. Financial advice is not my lane, but that's definitely like sparking some questions, so that's good for me. Yeah. So I had a question when we were back talking about loans that you do. Do you do like those rehab loans that flippers do?
2 or 3K?
Yeah. No.
Oh, that's like the FHA rehab.
Yeah, not that one. The one where like I have a lot of investors that are out of state and they just borrow all of the funds to acquire property and rehab and then sell it within a year. So you do those as well? What's your rate now? I'm seeing like 11%.
It probably changes like every single day.
Yeah.
I mean, you can get a little bit. It's gonna be 9 or 10% probably on that deal. But like we were talking about earlier, it's kind of irrelevant because if you're not holding it for that long, then
yeah, it's only a year. But then because we looked into it, we were thinking about flipping that one.
Was it only that? I think it was like upwards of like 16%.
It was
It was something crazy.
we had to pay like origination fees that were pretty high, and then
Yeah.
it was wild. The costs were wild. So I didn't know if you did that, because I would have a lot of customers for you if you did.
Yeah, I mean, you know, Scoot Mortgage, we can lend the money ourselves if we wanted to.
For just 1 year with
yeah,
the
I mean,
intention
whatever,
of buying and
yeah,
flipping.
whatever it is. I mean, so if you have a really good deal that is a no-brainer, I mean, I'm sure we could work something out.
Okay, cool.
Awesome. Appreciate you coming on.
Yeah, man.
That went by
really
quick.
insightful. It did.
I was
That's
like-
why I looked. I was like, oh.
Yeah, I learned a lot, so thank you for that knowledge drop.
Yeah.
And thanks for watching Cashed In.